Hi there, it's David Roche. It's Quantum Strategy. It's the mini podcast on macro matters, and good morning or good afternoon or good night or whatever. Anyway, a couple of major things to signal. One, are US retail figures, which were disappointing. And I think, in my view, although a lot of this was cars, I think we're going to get inflation from tariffs much quicker than people expect. And I think the tariffs will be increased in early April by large amounts on Europe, principally due to the president saying that Europe's VAT is some sort of unfair competition, which is, of course, rubbish. But I think we're looking at up to 20% tariff increases on many emerging markets and on Europe. So if the markets don't get upset by that, then the markets are dumb. So that's the first thing, which will, of course, in turn feed into into US inflation, which, to my mind, what I'm seeing is that the US economy is very mature, even if there were not other things happening like tariff increases. It will be difficult to repeat the economic miracle of the first Trump terms of office, and I would expect to see erosion of real purchasing power of wages due to rising inflation and a major clash between the Trump administration, or rather between Trump himself and the Fed, which, if it gains any traction, as I've said before, will be the end of the bull market in the dollar. Now, the performance of the US in general terms, let's say US exceptionalism, is extraordinarily dependent upon foreign equity inflows to invest in it, and on those inflows generating the strength of the dollar. For example, US equity flows in the last decade since 2014 have been about $18 trillion. Bonds had nothing to do with it. They were only about 1 trillion, minor. This 18 trillion, of course, increases the exchange rate, but it also increases the stock market. And I think that American exceptionalism actually stands on those two legs. And my guess is they will end this year. Principally, of the $18 trillion that flowed into US equities, about 9 of those come from Europe. And it looks to me like the relationships between Europe and the US is going to become so vitriolic that those flows will not be forthcoming in the future. And of course, they have to keep coming in order to maintain the dollar at its level, because the current account is naturally, $250, $350 billion negative every quarter. So that's an outflow. And unless that outflow is offset by principally equity inflows, the dollar starts to weaken. The US exceptionalism, which will not be getting the same amount of buying of equities either, will start to go down. And that will start to reflect the negative effects of Trump policies on the US economy. So that's my view. I've mentioned the US tariffs. They will be particularly heavy on Europe, on any other economy which has a VAT rate, which the president, who understands these things very poorly, considers VAT to be some sort of illegal subsidy. It is, of course, not. What happens is that when you build a product, you get taxed all the way down the line at the VAT rate for your value added, and you reclaim what people paid before or other companies paid before. When you export the tariff, the VAT, the total VAT is reimbursed. Okay, now that good then, say, goes to the United States, where it may be further processed, and it will go through the whole distribution chain. And at each level in the United States, it will pay GST, sales tax, so general sales tax. So VAT is one country's way of taxing a product. GST is the US's way of taxing a product. To consider that the tax system of another country is a hidden subsidy, when it is actually simply giving back the taxes paid there and paying them to the US in the form of GST, is, of course, mind-bogglingly incorrect, short-sighted, and stupid. But that's how it's seen. Now, if you take the difference between US tariffs and those of countries trading with the US as being the basis of the tariffs which the president is thinking of imposing, these are really the kind of remedial tariffs, as they're called. If they're simply based on the differences in tariffs, then the effect of the tariffs would be quite low. But if you add VAT back, then in the case of places like Brazil and Europe, you're adding 17, 20% to the tariff rate. That, I think, is what's going to happen. Now, in Munich, the Munich Security Conference is a big thing. And it was an even bigger thing this year because the US told Europe it didn't know how to run a democracy, which is a bit funny coming from a team which was implicit in having an attempt to discredit the US electoral system, which voted Trump out of office at the end of his first term. So we don't know how to run a democracy in Europe, but we do in the United States, where we deny the result of democratically held and verified elections. Well, that's a bit of a joke. But the biggest thing was that the US really kicked Europe out of any participation in the peace negotiations with the Russians. That's going to be a Donald Trump-Putin thing. That, of course, tears up the existing alliances to defend Ukraine, which raises the question of how will this be done if the pro-US Trump negotiates a deal with Moscow, which is unacceptable to Ukraine, principally, and to the Europeans. And we don't know the answer to that. But what is certainly true is the damage done to the transatlantic alliance, the 50-year treaty, which gave everybody peace and legal trading basis in the liberal world over is dead. And the liberal world order is also pretty well dead, in particular because the overriding principle of the Trump administration is to charge people for their protection by US forces. For example, Ukraine is asked to give the US 50% of its minerals, not only its currently discovered minerals, but all future discoveries of minerals, in order to reimburse the US for its help in defending Ukraine against Russia. Well, if that is the morality of global relations, then we're back to the days of Wagner and Pichogin, who has gone to his eternal reward. There is no morality left. You're simply dealing with mercenaries. And I think that is the overriding principle of the Trump administration in international affairs. And I think it is extremely negative for any orderly evolution of those affairs. And what it actually does is to diminish US power, because people will simply will consider it toxic in other countries, and increases the power of China dramatically to fill the soft power vacuum in terms of aid with its Belt and Road Initiative, and to attract the global South countries to a country which is reasonably economically successful and which offers a less colonial approach, frankly, to those global South countries. Okay, now the remaining thing I wanted to talk to you about was China. Some quite good figures from China. Total social financing showed the first signs that the credit machine is now reconnected to the real economy. There was a most noticeable rise in the lending to corporations, public and private sector. It hasn't fed through yet into households looking for credit. There's slight positive news on mortgages, but on the rest of household credit, very little. But that's not too much of a worry. It does show that something is gaining traction when it comes to stimulus. The second thing which is important is that since the discovery of DeepSeek, it is clear, or has become increasingly clear to international and domestic investors, that China is creating its own efficient frontier in technological terms, both cheaper and I'm afraid better than its American peers in Chat GPT type. Let's call it artificial intelligence of a general nature. So I think that this is going to buoy Chinese markets. It already has, but the Chinese tech sector is selling on around 12 to 14 times earnings, compared to about 30 times for any equivalent stock in the AI sector in the United States. So there's further to go in terms of valuation. And I think on that basis alone, given the economic traction which is occurring through the TSF, given the leap forward, and I would call it a leap forward, heralded by the Chinese technological sector, so far principally through DeepSeek, and the fact that President Xi is attending a conference of AI to give it its blessing from the state. It is one of the sectors like green technology where China seeks to actually restructure its economy around a series of growth pillars, of which AI is one. And so President Xi is going to actually turn up to a conference of the type of companies, both producers of AI and users of AI. And I think that also will spur confidence that we're not going to go back to the bad old days when leading technology companies were virtually closed down because their owners made disparaging remarks about the Communist Party. So that's a plus. Now, let's look at the data coming up this week to wind up. What are we going to get? Well, we've got the FOMC minutes, which are important to see how much debate is the current freeze on interest rate reductions, which is totally warranted. I think the next move in interest rates will be up. What members of the FOMC actually thought. So FOMC minutes are going to be important. And we're also going to get a lot of stuff about housing, building permits, housing starts, and existing home sales. And then in Asia, we've got a raft of central banks, though Australia and New Zealand, though they will quickly claim they're not in Asia. They may depend on it, but they're not in Asia. So Australia and New Zealand central bank meetings, and of course, China is having one too. Then a very key figure is the inflation rate in Japan, key because I think that economy is also gaining traction. And I expect that the wage rates will be substantial, even in real terms. So we're looking at further tightening. And we're looking at, say, policy rates at 1% and 10-year JGBs at something like 1.5 to 1.7, in my view, during this year. So we'll have to see if that is confirmed by the inflation rate in Japan, which is coming out this week. And we will also get inflation figures from Australia and India. Now, what are we going to get out of other places? Well, inflation for Canada, United Kingdom, and South Africa. The UK is pretty important in that because it's got a low growth inflationary environment, which puts the poor old Bank of England in a cleft stick. I think they'll go on cutting rates, but it won't have much of an effect on the economy. And the Eurozone releases its trade data, PMIs, and Germany will have its ZEW economic sentiment index, which I pay less attention to than the IFO, because the ZEW is really a load of analysts talking to another load of analysts, and we all know how useless analysts are. And then retail data from the UK, is it still stagnating? I think it is, because disposable income is now falling. And Canada will also give us its retail sales. And with that, I wish you a good day, and I look forward to seeing you online.